Welcome to Zero Noise. No fluff, no mercy, just the signal. I'm Michael Alpha.
And I'm Bella Vega.
If you're new here, I'm the guy who spent 2 decades on a trading desk trying to smell the smoke before the alarm rings. And let me tell you, I am twitchy about this tape. The price action this week, it didn't feel like a market. It felt more like a crime scene.
And I'm the physicist who takes the data Michael's panicking about and, proves his intuition is usually just a reaction to random noise. My job is to find the structure, the regimes, the math behind what's actually happening.
Today, our mission is, well, it's simple, but it's ugly. We need to figure out the violent cross-asset moves from the week ending January 30th. We have to understand why the bond market is puking, why silver got taken out back and shot, and why credit spreads, the canary in the coal mine, are just sleeping.
We have a lot to cover. We'll start with the macro regime and this strange negative stress index. Then we'll dig into the asset signals, specifically that gold melt-up, and then the subsequent wipeout.
And we're going to talk about the breakdown of the Fed-put correlation, why the systemic risk metrics might be lying to you, or at least not telling the whole story, and this huge spread between the VIX and what's actually happening.
And finally, we will connect all that math back to reality, the Warsh premium, the massive armada, and this idea of a trust asset.
Okay, let's get into it. The macro regime snapshot. Look, I know you trust the dashboard, I get it, but you cannot look at this week and tell me the system is fine. We had real assets up 11% in a month, while crypto gets hammered 6% in a week. That's a massive divergence. It feels like a phase transition. We're leaving that patient Fed world and entering something way more violent.
And this is exactly why we look at the data. You see violence, the system sees noise. The composite stress index is sitting at negative 0.4036.
Negative. The screen is bleeding red. How is the system less stressed?
Because stress in this model measures function, not price. It's about funding liquidity. It asks, can banks still borrow from each other? Are treasury spreads blowing out? Is repo seizing up?
And the answer is no.
The answer to all of that is no. The plumbing is working perfectly fine.
Okay, so the plumbing's working.
The plumbing is pristine. It's just that the water flowing through it is scalding hot. That's the difference. A funding crisis like '08 or March 2020, that's when the pipes burst. This is a repricing.
But that disconnect is what scares me. When the price action screams regime change, but the index says all clear, it usually means the index is just lagging. It feels like we're watching the tide go out before a tsunami, and your model is saying tide levels are normal.
Or it means the sell-off is orderly. The yield curve is an inverted slope, is positive versus 0.74. And look at the regime labels. Yes, equities are in mid-vol, but high-yield credit, HYG, still stubbornly in low vol.
Right, credit. We're definitely coming back to that because it's the key.
Yeah.
But let's look at the damage, the asset level signals. You want to type repricing. Look at gold, GLD. The 1-year Z-score is 3.08.
A 3 sigma event.
3 sigma. I mean, that's statistically absurd territory, a total melt-up.
It was a melt-up. But you have to see the tails on both sides. The 1-week Z-score is negative 1.53. That's a whiplash-inducing mean reversion. We saw gold hit 5,600, silver at 120, and then Friday happened.
Friday was a flash crash. Silver down 28% in a day. That's not mean reversion. That's a liquidation event. That is someone getting a call from their risk manager.
We'll get to the why later, but just looking at the signals, the vol in indices is idiosyncratic. It's not happening everywhere else. Look at oil. USO, 1-week Z-score is positive 1.33. That's a big move up, while metals got slammed down.
That's the geopolitical premium. That's the massive armada headline. Oil traders are pricing in a supply disruption.
Correct. And look at emerging markets ex-China, positive 1.53 Z-score on the 1-year. It's decoupling. But, Michael, again, I have to point out what's not happening.
Go on. Ruin my panic.
Credit spreads, BBB spread Z-score, negative 1.28. And CCC, the junk of the junk, negative 0.3S. These spreads are tight. If this was a real solvency crisis, they'd be blowing out. They aren't.
So the bond sell-off is just about rate levels, not credit quality. Companies can borrow, they just have to pay up for it.
Exactly. The market is saying that even with higher rates, corporate cash flows are strong enough. It's a vote of confidence, weirdly enough.
Which brings us to the real headache. It's not just that things are falling, it's how they're falling. Together, the correlations are just broken.
You're talking about the stock-bond correlation.
I'm talking about the death of the 60-40 portfolio. Look at the 1-month correlation between SPY and TLT.
It's positive 0.56.
That is a nuclear winter for risk parity funds.
Because they need that seesaw. Stocks down, bonds up.
Exactly. The whole premise is that bonds are your buffer. But when the correlation flips positive, when you get rates up, stocks down, the seesaw just snaps. Both sides hit the ground at once. The leverage kills you.
Which would explain some of the mechanical selling we're seeing. But there's another decoupling that's just as violent. Look at SPY versus FXI, Chinese large caps.
Okay.
The correlation has flipped to negative 0.79 over the month.
That's extreme. Usually in a global risk-off, everything gets hit. Contagion.
But this isn't contagion, it's divergence. U.S. markets are trading on Fed policy fears. China is trading on local growth failure. Their PMI contracted. It's a local deflationary bust versus a U.S. reflationary shock.
So you can't even hide in China. And then there's gold. Correlation to equities is basically zero, negative 0.14. It's not risk on or risk off anymore. It's what I've been calling a trust asset. It's trading on a totally different axis.
We'll get to that. But first, the systemic risk scores. We note the stress index is low. The system turbulence percentile is at 52.68%.
52%. That feels way too calm. How is the system only moderately turbulent with silver crashing like that?
Because of the Mahalanobis distance.
Gesundheit.
Funny. But think of it like this. The market is a flock of birds flying in formation. If the whole flock turns left sharply, that's high volatility but low turbulence. The formation is holding.
Okay, I'm with you.
Mahalanobis distance measures how much the formation is breaking apart. This week, gold flew into a jet engine and rates dove towards the ground. But credit, FX, broad equities, they mostly stayed in formation.
So because the whole flock didn't scatter, the math says moderate turbulence.
Exactly. It tells us this is a sector-specific liquidity event, not a systemic solvency event.
So the engine isn't blown, but the transmission is making a hell of a noise. Which brings me to my favorite part, the price of insurance. Volatility pricing.
You do love the VIX.
The VIX is at 17.44. That's the 56th percentile. Elevated, but not panic. But GRCH, the realized vol, like what actually happened, is at 10.84.
32nd percentile.
The spread between them is 6.6 points.
Which is in the 84th percentile historically.
A massive gap. That is the fear premium. Traders are paying up for options because they do not trust the calm. They're hedging the unknown unknowns.
It's not just paranoia, though. It's rational pricing of tail risk, and there's a structural reason for it this week. Data opacity.
Yep.
The BEA rescheduled the GDP and PCE releases.
We're flying blind, exactly. The market needs that data to calibrate. Without it, the confidence interval around fair value just gets wider. So dealers jack up the price of options. That is the dark data premium.
Moving on to regime identification, this is the report card.
What's the verdict?
TLT, long bonds, officially in mid-vol, probability of 0.94, that stability we had in rates, it's gone.
And gold.
Gold is the only major asset in high GH vol, probability 0.82. It's been behaving like a crypto asset for months now.
But the anchor.
HYG, high yield, still in low vol, probability 0.97. It's been there for 40 weeks.
And that is the line in the sand. As long as credit stays in low vol, this regime is transition. If HYG flips, then we're talking about a crash. Right now, credit investors just care about cash flow.
Precisely. Which brings us to the why. Let's connect this to the news and geopolitical risk. What actually drove these numbers?
The main event. The elephant in the room. Friday, January 30th, the war shock.
President Trump nominates Kevin Warsh to succeed Powell. The market reaction was immediate.
Immediate doesn't cover it. It was a violent rejection of the status quo. For a decade, the Fed has been the nice guy. They suppressed vol, bought bonds, promised soft landings.
And Warsh represents the opposite of that.
He's the guy who says the Fed is addicted to easy money. The market reads Warsh, and it reads regime change. It reads financial repression is over. Real rates are going higher.
Which explains the bear steepener in the yield curve. The market is demanding a huge premium because the Fed put, that safety net, just got canceled.
Exactly. And higher real rates are kryptonite for gold. Why hold a rock that pays 0 when you can get 5% on a T-bond? That's what triggered the liquidation.
But before the crash, gold hit 5,600. This brings us to event 2, the trust asset trade.
That wasn't an inflation trade. That was a panic room trade.
The report calls it the trust asset thesis. We've got headlines about the U.S. annexing Greenland.
Which is just wild, by the way.
Tariffs on Canada and sending a massive armada to the Middle East. If you're a foreign sovereign, do you really want to hold U.S. Treasury bonds right now?
No way. You buy gold because gold has no president. It has no phone number. It's the only asset that isn't someone else's liability.
So gold went up on sovereignty risk, and then it crashed on liquidity needs.
Precisely. The Warsh news hits, the bond market pukes, leveraged funds get margin called, they have to raise cash. What was their biggest winner? Silver. They smashed the piggy bank to pay the bill. That's why silver fell 28% in a day. It was purely mechanical.
So to put it all together, a
Yeah.
strong macroeconomy, but a political and monetary regime that is shifting violently. And the market is trying to price all of this in at once while flying blind on key economic data.
That's it. It explains the paradox. High price volatility, low systemic stress. The machine isn't broken, the operating system is just being reinstalled, and the progress bar is stuck at 99%.
Which leads to our final thoughts.
My final thought is this. The silver wipeout was a warning shot. You don't see a 28% drop in a major asset without seeing bodies float to the surface later. Liquidity is much thinner than the VIX suggests. Don't trust the calming credit. It's the last thing to break.
And mine is about structure. Structure matters more than stories. The signal to watch is the correlation matrix. If that equity bond correlation stays positive, the entire architecture is under stress. And watch high yield. As long as HYG is boring, this is a repricing. If HYG flips to high vol, then it's a recession.
Keep your eyes on the spreads and your hand on the eject button. This is zero noise.
End of transmission.